In this episode of CMB Connect, I'm sitting down with Lyn Crutchfield, Director of Sales Operations at Essent and a fellow CMB, and we dive into the critical world of private mortgage insurance, or PMI. Our conversation is around how PMI helps buyers achieve homeownership, supports lenders, and how it adapts to a changing regulatory environment. You don't want to miss this. Hi, Lynn. Welcome. It's so great to have you here. I know our listeners will really benefit from our discussion today, and especially from your generously agreeing to share your expertise with private mortgage insurance, and particularly its impact on the mortgage market, both on the lenders and the borrowers.
First, I'd like to say thank you for giving me the opportunity today to talk about something that's near and dear to my heart.
I wanted to go back to the beginnings. How did you, of your career, how did you enter the mortgage market? How did you decide to have a career in mortgage banking? And how did you decide to even pursue a certified mortgage banker designation?
I have worked in mortgage and mortgage affiliated industries for 32 plus years. And really, I got started in the industry shortly after I graduated from college as sort of a fluke, honestly. I started with a temp firm as a receptionist for a mortgage company, and it took off from there.
Mm-hmm.
I received my CMB in 2009. The reason that I pursued it and that it was important to me is I wanted, one, to be able to learn more about the industry, as well as be able to contribute to the industry and help those in ways that were coming behind me, if you will, and helping them learn more about the industry as well. And the CMB is a great tool for that. And to give back to the MBA for all that the MBA does as well. So having grown up in the mortgage industry, I started, as I mentioned, in the lending side. And shortly after joining that temp company, I transitioned into a processor, went on to serve as a closer and an underwriter. And I've worked with an LOS company as a trainer and customer experience. And shortly after the crisis, I ran operations for a due diligence firm. The reason I mention those is because all of those things have contributed to my career growth and also assist me in the mortgage insurance world. I've been in the mortgage insurance industry for 23 of those 32 plus years.
Wow.
My focus there has been lender ops, sales ops, product development, customer experience, and support. I joined Essent team in 2011 as the head of the customer support team. And currently I serve as director of sales operations. And of course, that certified mortgage banker has bolstered me through all of those things because of the knowledge you gain by being a CMB.
This is great background.
Thank you.
To kick off our conversation today on private mortgage insurance, I want to start with a simple definition of what exactly is private mortgage insurance, and particularly what role does it play as a risk mitigation tool for lenders, for example.
So one of the most significant barriers for many people is saving the 20% down payment to purchase a home. Private mortgage insurance, also known as PMI, helps borrowers by giving them the ability to have a lower down payment while still covering the lender to be able to provide a tool for managing their risk exposure on those conventional higher LTVs. So simply put, it is insurance for the lenders against default. Lenders can manage, as I mentioned, their risk exposure using it. One of the things they can do is they could require it on all conventional loans with less than 20% down. If the loan is being sold on the secondary or to the GSEs, it's always required on those conventional loans. One of the important things about PMI is that if there is PMI on the loan and the loan, there's defaults, then the PMI company covers first loss, which equates to the management of that risk exposure for that lender and creates a shared risk, if you will, between the two entities. It's based on a standard coverage, which is structured based on loan parameters. It's determined based on loan parameters. The rule of thumb that you can think about when you are thinking about PMI is that the higher the LTV, the higher the risk of defaults. And so therefore, the higher coverage is needed. An illustration that I could give you that might help connect all those dots is that on a standard 30-year fixed rate, let's say that the sales price is $300,000. The borrower is going to put 10% down, hypothetically, which is going to take it to a 90% LTV.
Mm-hmm.
The standard coverage for that product is 25%. What that means is the private mortgage insurance company is going to cover 25% in the event of default. And remember, we're covering first loss. 25% of that loan amount, $270, is $67,500. So the risk exposure for that lender has been reduced by $67,500,
Mm-hmm.
making the lender's risk exposure $202,500 instead of the full $270.
Given that amazing impact of the private mortgage insurance on mortgage lenders, are most probably some regulations, and maybe not some, maybe a lot of them. I know about the private mortgage insurer eligibility requirements, but I don't know enough. So what are those? When were they put in place, and who's in charge of enforcing those?
Okay. So with the private mortgage insurance partners, there's two aspects that we have to adhere to. One, we're required to be licensed with every state insurance department where we offer mortgage insurance. And that's because they approve our rates and our standard forms like the MI certificate. Under private mortgage insurance eligibility requirements, which is, Fannie and Freddie govern us, and they use that primarily when working with us as a governance.
Mm-hmm.
It's also known as PMIERs, and it has several strict financial, operational, and legal requirements. FHFA, because they govern Fannie and Freddie, they provide the direction on PMIERs. Some history to talk about how it works is that, back during the 2008 Great Financial Crisis, the MI companies were under financial stress and 3 went into runoff. So PMIERs was implemented to establish confidence in the private mortgage insurance companies' financial strength to be able to pay their claims. Some examples of those financial requirements that I mentioned a minute ago. One would be that we have liquidity stress tests. There are requirements for reserves and available assets to be able to pay the claims. So both of those are key aspects. There's many more, but there's other, those are key. If the PMI partner does not meet the PMIERs requirements, the GSCs, Fannie and Freddie, actually can take action. That could be as strict as not allowing the PMI partner to be able to write business any longer, new business any longer. So it really can be impactful.
Yeah.
One of the other things PMIERs does is, as part of all of that, there's several things. The Master Policy Agreement. Back in 2020, the PMIs worked together with the GSCs to develop a uniform contract called the Master Policy. That contract is between the lender and the PMI partner. So it contemplates the mortgage underwriting process, mortgage insurance underwriting process regarding non-delegated and delegated. Non-delegating be where the lender submits the credit file to us, and delegated being where the PMI partner actually gives authorization to the lender to be able to rep and warrant that it meets the MI guidelines, the applicable MI guidelines. PMIERs governs that approval process for delegated underwriting is one of the aspects. And in that governance, it requires the PMI to ensure that the lender meets the requirements of established high quality and compliant loans. And it also may have a higher quality assurance. In addition, the MI companies under PMIERs have a quality assurance for PMIERs themselves. And the MI companies under that are to ensure loans and lenders are also performing at the PMI standards. So much like lenders have standards conforming, we need to confirm that the insured loans guidelines are met, that the data is accurate to prevent fraud. One way to think about it from a lender's perspective is if within those QC PMIERs requirements, if the loan is not meeting the MI's guidelines, then there's a significant defect. What that means for the lender is a repurchase from the GSEs or the investor because it no longer meets the MI guidelines. It no longer has the coverage required. So that's why all of that QC is so important.
It just strikes me that private mortgage insurance, it has such a almost outsized impact on mortgage lenders and mortgage lending, and any change in regulation, for example, that regulates a PMI company will affect the lenders. Can you talk a little bit more how this can impact lenders and what kind of compliance challenges or opportunities exist?
Yes. So I mentioned the state insurance departments that the PMI partners have to be licensed with and who approve our rates and documents. While those things change infrequently, right, the approvals and the licenses are with each state. And so approvals occur state by state. If you have a footprint that is broader than one state, that is a consideration from an operational perspective for the lender.
Got it.
The other is that from a PMIERs perspective, there are also considerations. Given that PMIERs requirements regarding financial strengths and there could be changes there, when there are changes, lenders should evaluate that PMI partner based on their ability and willingness to pay claims under PMIERs rules. Strong capital positions and investment grade ratings they speak to the PMI's partner strength and claims paying ability. So there are a couple of pillars to think about. You have the balance sheet. That's where the rating agencies rank each PMI partner based on their financial strength. They also meet annually with the executives to discuss management and strategy, so it's pretty comprehensive. Reinsurance, that just adds another layer of protection in the event of a catastrophic event. Quality mortgage insurance portfolio, that speaks to the PMI partner's credit policy, loss management and servicing processes. And then again, capital liquidity for paying claims is always critical. So those are things under PMIERs, the lender, that really could impact the lender. Something that's not necessarily regulated or governed would be the PMI partner's value adds or service levels. Those can also be important to a lender based on the lender's needs.
This is very, very interesting. So we talked about the fundamentals of what is PMI, the different structures and the regulations. And now I want to get deeper into the private mortgage insurance business and terminology and things like that, and talk about the different types of PMI available. Can you walk us through the various premium options, for example, borrower paid versus lender paid PMI, and just give us more context and deeper insight into that?
Sure. There are two premium payment types in the mortgage and private mortgage insurance. One's a borrower paid premium, just like it says, it's paid by the borrower and it can be added to the monthly premium or to a lump sum. The lender paid premium is paid by the lender. Most often it's done with a lump sum, and it's typically where the lender will charge a little bit of a higher note rate to offset the cost of the mortgage insurance. We do offer there is a monthly option for lender paid. It's just not frequently used. The standard industry plans under those payment type, premium plans. We have monthly, you have single, and you have split premiums.
Once the borrower gets mortgage insurance, is this going to be a lifetime commitment for the borrower, or are there ways to eventually for the borrower to drop the mortgage insurance?
So, is it is it forever and ever? One, mortgage insurance is for the mortgage, so it's on the mortgage and not the borrower, right? So the answer is no, it's not there forever. The Homeowners Protection Act of 1998 was established to provide some guidance around cancellation on borrower paid single family residential loans that were closed on or after July 29th, 1999. Seems like a lifetime ago. It's also known as the HPA. So it establishes conditions where the borrower can request cancellation for those loans, or the servicer can automatically terminate the MI. Now, the servicer is responsible for notifying the PMI partner about the cancellation or termination. The PMI partner is not responsible for managing that process. The borrower has the ability to cancel themselves for qualified loans for the HPA under HPA. They can cancel when the LTV or request cancellation when the LTV hits 80%. The servicer for those qualified loans will automatically cancel or request termination at 78% LTV. So if the borrower doesn't request it, the servicer is automatically going to do it if it meets the requirements.
When lenders decide on PMI coverage, for example, choosing between 25% or 35%, what factors go into making that call, and what's driving the decision?
I mentioned a little earlier that there's standard industry coverages. The GSEs really they're the ones who have set that coverage percentages, and they're used broadly within the industry because of the way the GSEs have it structured. The coverage is based on loan parameters like loan product, term, and LTV. And I'll give you an example. On a 97% standard 30-year fixed rate, the coverage for that is 35%.
Got it.
But if you take it and make that same loan a Home Possible or a Home Ready, the coverage percent drops to 25%. If you change the term to 15%, then there's a different coverage because, 15-year, sorry, not 15%. If you change it from a 30-year to a 15-year, it then changes again. There are also coverages out there for affordable products that you may be doing something with a housing finance agency, and they set their own coverages. So there may be differences in coverages for those as well.
Fascinating. Now, let's talk about the numbers from the borrower perspective. How is the actual PMI premium calculated, and what factors influence how much a consumer ends up paying?
I'll answer the first question. I'll go first with how is it calculated? And so with the PMI rate is provided, and I'll talk about that in a moment, but when the PMI rate's provided, the calculation for the premium varies depending on the PMI premium plan. I mentioned earlier monthly, single, split premiums. On a monthly plan, you'll take the loan amount, multiply it by the insurance rate, and divide it by 12. On a single premium, you're going to take that loan amount and you're going to multiply it by the rate for a lump sum premium. On a split's a combination. It's part monthly, part singles, or part lump sum. And so you'll have both. On the monthly portion, you'll calculate it just like a monthly premium. On the upfront lump sum premium, you'll calculate it just like the singles would calculate. Now, historically, how do you get those rates, right? That's the important question. Historically, PMI partners, or the rate, was derived by using a handful of parameters, and the PMI partners provided it on rate cards. Those parameters were LTV, credit score, and loan amount and term, or not loan amount, but product type and term. The PMI partners, as I mentioned, just provided a rate card. However, in recent years, all of the PMI partners have transitioned to what the industry calls a risk-based pricing model. For example, with Essent, our risk-based pricing model is called Essent Edge. And using it, we calculate the premium based on up to 400 plus different credit data elements so that we can provide the best rate for the borrower's credit profile. And we guarantee that quote as long as there's no changes to the loan parameters. Often the PMI partners, we all have different ways of being able to obtain a quote and order with us. We frequently have online tools as well as work with integrated solutions. Essent's Rate Finder tool, just to give an example, the Rate Finder tool is our online solution. So lenders can go into the Rate Finder tool, enter the loan parameters to obtain a rate quote from us. They also have the ability to do a comparison of the different plans, the single, monthly, splits, even FHA, if they'd like, right there on the screen.
Yeah. Now let's take it a step further. When might a borrower paid versus lender paid option be better for the consumer, and how do lenders and borrowers consider, what route to take? What's the decision-making process between those two?
What's the decision-making process? Yeah. So when a lender makes less than 20% down payment, the PMI will provide the lender with the flexibility to structure the loan in several different ways. Borrower paid and lender paid options each have strategic uses when determining the loan solution that best meets the customer needs. Consideration may include affordability, eligibility, and cancellation when you're looking at a private mortgage solution. From an affordability perspective, it's important to note that the borrower pays the borrower paid premium. Any qualifying interested party contributions, so the IPCs, may be applied if they're using a lump sum premium like singles or splits. When using a monthly plan, the monthly premium is included in the mortgage payment, and consequently it's included in the PITI, and the DTI. So that's a consideration. Okay. If using the lender paid MI, again, typically they've got a higher note rate, and this option may also impact the borrower's mortgage payment. Well, it will impact the borrower's mortgage payment and the DTI as a result. So you need a comparison to know which one's the most beneficial. The borrower paid premium options can also be used from a qualification process, so they can be used very tactically there. An example may be, again, the borrower may have assets or IPCs that could be used for that single premium, or make it a viable option. Or if they have limited funds, maybe the monthly premium is a better solution. Or if they don't have limited funds, but they just have an investment strategy where they don't want to liquidate any of their funds, So you've got a lot of flexibility there.
Mhm. So yeah,
Go ahead.
the borrower participates in this decision-making process together with their lender, correct? They're
But yes, borrower does participate. LOs LOs do present it to them, and they get to be able to make decisions based on their needs.
And so far we have talked about private mortgage insurance as a risk mitigation strategy in a way for the lender. But it isn't just about risk. It can also be a powerful sales tool. And when we have high interest rate environment as we had for the last 2.5 years or so, how can PMI products help lenders stand out and attract more borrowers by having access to the best PMI products out there?
So lenders can leverage PMI in multiple ways. One way is they can gain access to a broader market with opportunities to build relationships or
Yeah.
build upon relationships with real estate agents, and the referral business for home buyers for future business. Another is the ability to offer affordable housing products with less than 80% area media income, therefore building out their affordable housing footprint and putting more qualified home buyers into homes. It provides a method for the borrowers, as we've talked about, as little as 3% down, which is especially beneficial in the first-time home buyer market. With the first-time home buyer, by assisting lenders to place qualified home buyers, the home buyer is able to build equity sooner, get away from that risk of the rent, if you will. And if they're closing on mortgages, they're making mortgage payments, which therefore gives them the ability to build out their credit profile.
Mm-hmm. Strategically speaking, how does the cost of PMI influence, for example, the lender's decision to offer conventional affordable loan, as you were saying, like 97% LTV versus an FHA product? So I'm just wondering if there are specific scenarios where the PMI might tip the scale in this situation.
When structuring loan scenarios, a lender may look at the scenario using conventional or FHA, as you mentioned, and both mortgages or types of mortgage have a place in the lending world for the best solutions for borrowers. Reasons to consider when looking at these offerings include credit profile, costs, and the loan structure needs. It is traditionally used for borrowers with challenging credit profiles. The insurance structure is a lot like our splits in that it has a monthly and a single premium aspect to it. And the loan scenario you need to remember is on the monthly portion of FHA premiums. It's for the life of the loan and it's not cancelable. The pricing on the FHA for the mortgage insurance portion of that loan is fixed.
Mm-hmm.
With private mortgage insurance, it's used with conventional products, which can mean that it's got more possibilities when structuring the loan. The various premium plans that we've talked about can be leveraged to structure it to best meet the borrower's needs. And there's a couple of things I'll add here about those. And of course, if it meets the HPA requirements we just spoke about, it can be cancelable. On a monthly payment structure, it's the most often used product in the industry. There are no premiums collected at closing. So if you're managing closing costs, that's something to consider with it that we haven't talked about.
Mm-hmm.
The single premium is a lump sum payment, and it's typically used if the borrower prefers not to have the monthly payment. It can be financed into the loan, or it can be paid at closing, and they can apply those IPC or use their own assets. Split premium, which is the combination of monthly and singles, that product is a tool that's often used to be able to manage DTI if there's, on the cusp. The structure's a lot like the FHA, so it's got the monthly and the split, the singles. Just like the single PMI product, the lump sum can be financed or it can be paid in full. The borrower or IPC funds can be applied there.
Mm-hmm.
So,
yeah.
all right, thank you.
Okay. Okay, Lynn, are there any recent regulatory changes or updates that mortgage bankers should be aware and need to be aware when they are working with PMI?
Great question. Because of the way we work, many of those key changes, regulatory changes or industry changes that impact mortgage companies also impact the PMI companies or partners. One of the ongoing one that's a big impact that I can think of off the top of my head would be the change for their initiative FHFA, tongue tie. It's an initiative to migrate from the tri-merge to the bi-merge.
Mm-hmm.
And of course, the transition to the new scoring model. That's huge, not just for the mortgage companies. Another one would be the CFPB's proposed mortgage service rule changes.
Mm-hmm.
Really, that rule is, to bring some of the things we learned from COVID and communication needs forward with servicing. But it doesn't just impact the mortgage side. It does impact the PMI side. As a part of how we work so closely with those PMI. The changes to include the best practices with frictionless forbearance and the potential of suppression of credit reporting during that time. In addition, the premium processing could be impacted from that, and pertaining to HPA's cancellation, loss management, and more. So that's one to consider. CFPB ruling and FHA direction for Fannie and Freddie regarding regulatory framework and guidelines can impact us. It could be as simple as loan amount changes, and those are impactful for us just like they are lenders. MISMO data standards like ULAD, that's impactful, as well as affordable housing initiatives, and those are just examples.
Good points, and we'll make sure that when we release the podcast, I'll put the links to those regulations that you mentioned. But
I do have one rule of thumb there.
Yeah.
If the lender has a question on whether or not it impacts the MI company, the best practice is to reach out to your local PMI rep and ask. They'll be able to help with that question.
Excellent advice. So switching gears a bit, I'd love to hear your take on careers in mortgage insurance, in private mortgage insurance. And I want you to talk a little bit about what kind of roles are available in your industry segment and what kind of skills, experiences are in demand right now.
So many of the skills that you might have in mortgage are transferable or the same in a private mortgage world. Mm-hmm. We have career paths that range from underwriting and different roles for underwriters, data analysts, sales, risk management, compliance, finance, technology, and more, right? So there's all very similar things that you would find potentially at a lender shop. Lots of opportunity.
I think when things are shifting like we are seeing now, this is very good to know that some skills that mortgage professionals have can be transferred to the mortgage insurance industry, which, as we are learning right now, it's extremely important in the loan production process. But I want also your advice from your perspective. If someone, for example, is already established in the mortgage industry, they're a loan officer or an underwriter maybe, but they're kind of mid-level professional, how would they transition into a career in private mortgage insurance? How do you see that transition from your perspective?
From my perspective, one of the things they should do is I think they should reach out and develop those relationships with the PMI partners or the local representatives and others in the industry. So just broaden their network. I think they should also follow the PMI partners career sites to see what opportunities are out there and highlight those transferable skills in their resume and on LinkedIn. That's a great way to get exposure especially if you're using your network.
Right. And how about someone who's just starting out, for example, a young college graduate? How can these people break into your industry, into the PMI segment of the mortgage banking industry?
So some of my advice here would be very similar to the other. I would say follow the career sites and highlight any transferable skills that they've gained through college or through any work that they may have already experienced on their resume and LinkedIn. I think job fairs are always a good thing to break into a business. And then, of course, look for management training and internships.
Yeah.
The one thing that I've experienced personally in the mortgage and mortgage affiliated industries and mortgage insurance is that people are glad to help new entrants or people looking for opportunities. It's a very inclusive industry.
Yes. I cannot agree more with you. And we actually do participate in something that Fannie Mae does. They have a program called Future Housing Leaders. And we work with those young professionals. But it is Fannie Mae that gives that inclusive opportunity for a wide range of young professionals to get a taste of what it is to work in our industry through paid internships. And I have seen some PMI companies participate in that.
That's a great opportunity. You're right.
Yeah. Looking ahead, what are the emerging trends and technologies that you see shaping the future of the mortgage insurance industry? And are there any opportunities or any threats that you see on the horizon arising, especially from the AI and machine learning technologies, especially the generative AI that we have experienced in the last 2 years?
So, like many of the things we've discussed today, what impacts the lending side is very similar to what impacts the private mortgage side. As an example, private mortgage partners often integrate with the loan origination systems or the point of sale systems to be able to provide lenders the ability to quote or order. Those platforms, including servicing platforms, continuously change with technology. And so we have to work with them to ensure that we are able to integrate workable solutions for the customers or for the lenders. As far as generative AI, that's a great question. It's interesting in my perspective. I think as the financial world and mortgage insurance industry specifically, there are potential threats and opportunities for sure. The first potential opportunity that comes to mind for me would be the ability to leverage generative AI in responses that are to the customers and to streamline some workflow there. I think it can be used for those human-like interactions, those initial human-like interactions, to help through chat bots or voice bots or virtual assistants.
Yeah.
Having said that, there are some considerations, and one of the primary considerations I would think that you would have with that is the governance of information that is shared.
Right.
Whether it be from the person who's contacting the private mortgage insurance company or whether it's the private insurance company responding.
Mm-hmm.
Like lenders, PMI partners are responsible for handling a lot of sensitive data, and so security is the highest priority to us. It's really going to be interesting to see how that evolves in the industry.
Yeah.
And to see how it impacts all of our security and regulatory processes.
I agree. And I do agree also that data and guardrails around the use of AI and access to customer information is crucial in terms of our ability to leverage this technology.
Yes. It's exciting, but
Mhm.
but it's still very new, right?
Well, we are coming to the end of our podcast, and I was just wondering if there are questions about the private mortgage insurance industry that I should have asked, but I didn't ask. If there is anything else that you might think would be interesting to add.
From the private mortgage insurance perspective, I will say, and it goes back to one of the questions that that we've already discussed, but I think one of the most exciting things about the partnership between lenders and private mortgage partners is the ability to work together on flexible solutions that best meet the borrower's needs and to be able to provide a mechanism to place more qualified home buyers in homes.
Mhm.
I have really enjoyed working in this industry and knowing that it's part of the mortgage process and helping those borrowers, qualified buyers.
Lynn, this has been incredibly insightful conversation, and I want to thank you so much for sharing your knowledge, your expertise around PMI with us today. I think knowledge around PMI, how it works, how it impacts borrowers and lenders, how lenders can leverage it, and not only as a risk tool, but as a sales and strategic tool, as we discussed, is super important. And it has been a real pleasure to talk to you and to have you on the podcast today. And I know that our listeners have gained a lot from this conversation. Again, thank you so much for participating in the CMB Connect podcast.
Thank you for the opportunity. It's been a pleasure.
That's all for today's episode of CMB Connect. Thanks for tuning in, and remember to subscribe for more conversations with industry leaders. Until next time, keep connecting, keep learning, and keep pushing the boundaries of innovation. This is your host, Val Boras, signing off.